Risk tolerance and asset allocation. It doesn't get any more fun than this. Hi, if you're new to the channel, my name is Tay from Financial Tortoise. In this channel, I discuss personal finance, investing, and all the while surviving in a multi-generational household. If these topics sound like something you'd like to learn more about, I would much appreciate it if you consider subscribing and also hitting that like button. And if you have yet to download your free copy of Sandwich Generation's Guide to Financial Security, 10 Steps to Securing Your Family's Financial Future, please go to my website at financialtortoise.com and do so. I send out weekly newsletters with other great tips on mastering your money, and I wouldn't want you to miss them. Gretchen Rubin, the author of 4 Tendencies, talks about how self-awareness is key to self-mastery. In the same way, when it comes to mastering your investments, knowing your risk tolerance is akin to self-awareness. Only when we know how much risk we're comfortable with can we apply that to setting our ideal asset allocation and become a successful investor, one that is aligned to our personal preference and natural inclination. Are you the type that is so risk-averse that despite having $1 billion, you keep it all in a bank savings account despite its ridiculous 0.03% interest rate? Or are you an extreme risk-taker who thinks nothing of investing hundreds of millions of dollars in speculative investments? And even at the brink of bankruptcy, you have no trouble sleeping. Most likely, you're probably somewhere in between. But the most important factor is that you have the self-awareness to know where in the spectrum you fall. On October 9, 2007, the Dow Jones hit its high and closed at around $1,400. By March 5, 2009, it had dropped to $6,500, more than 50%. For those of us who own stocks in a severe bear market, we have all experienced this dilemma. Should we sell? Regardless of how we may think we will behave in such an unnerving situation, it's really hard to predict how we will really behave. And whether we like to believe it or not, there almost certainly is some point during a market decline when we all have considered selling. Just imagine, you're in a severe bear market and you're watching your hard-earned money steadily erode week after week, month after month. People are talking about gloom and doom all around you. You have no idea how much further your investment will drop by. Should you sell now to cut your losses? How much longer can you endure when the news is constantly proclaiming that the market will only go down further? Everyone is saying that the worst is yet to come. And to make it worse, your friends and family are selling their shares and are encouraging you to do the same. In such a scenario, what would you do? Will you sell, or do you stay the course? Such a scenario was what millions of Americans were dealing with during the 2008 financial crisis. It seemed like there was no limit to how far a stock could fall. And when the panic set in, our emotions take over and they become our worst enemy when it comes to investing. But a good, solid asset allocation will be your best weapon against such situation. A good asset allocation that is aligned to your risk tolerance will help you resist the temptation to sell funds in a declining market. You can honestly tell yourself in a down market that, no, I'm not going to sell because I learned that the US market will always recover and my asset allocation is suitable for my risk tolerance. A popular method that many people recommend to help determine if your asset allocation is really right for you is what's called the sleep test. Once you have set up your asset allocation, ask yourself, can I sleep soundly without worrying about my investments with this specific asset allocation? The answer should be yes. Stocks and bonds naturally have their cycles of up and down, and we all need to be comfortable with that fact. Experienced investors understand this cycle and volatility. And we know that by simply changing our allocation between stocks and bonds, we can reduce the level of volatility in our portfolio until we reach our ideal sleep level. But you and I are investment nerds, so we like to take it a step further with a more objective method than just a simple sleep test. So let me consider 5 key factors you should consider when determining your risk tolerance. Number 1 factor is your income. Your personal financial situation is one of the key factors you want to consider when determining your asset allocation. For example, if you have a stable job with consistent income, you may be okay with taking greater risk in your portfolio. However, if you don't have consistent income because you're in a contract position or you have your own business, you might want to take a more moderate or conservative risk stance in your portfolio. Another factor you want to consider is the time frame to withdraw. Stocks are usually unsuitable for short time frames. Think less than 5 to 10 years. For example, let's say you're investing for retirement, which is in 2 to 3 years. If you had your investments in all stocks and the market tanked, like it did during the height of 2008 financial crisis, your portfolio would be worth only about half its previous value. Stock market ups and downs become less and less when the investing period lengthens. Stocks are actually poor investment for short term, but excellent investment for long term. So therefore, if you're needing to withdraw your money within a few years, your risk tolerance would be moderate to conservative. Whereas if you don't need to withdraw the money for the next few decades, you should be okay with higher risk tolerance given you have time on your side. A third factor you want to consider in determining your risk tolerance is personal obligation. Are you a single guy or girl with no other individuals dependent upon you financially? Or do you have a large family where people are depending on you to financially provide for them? If you have no other individuals depending on you, you can have higher risk tolerance given you have the ability to taper your lifestyle down if the market is in a bear market. Unless you have an especially expensive lifestyle, you have the ability to move to a cheaper location, eat rice and beans for months, and take public transportation to work. Now, do you want to? Likely not if you don't have to, but if it is just you that you need to feed and take care of, you have that option. If you have family members, spouses, kids, and aging parents that might be depending on you, maybe not so much. You can't just pick up and move to a cheaper cost of living location. Your kids likely wouldn't want rice and beans every night, and it would be quite strenuous trying to move a large family in public transportation. It can be done, but not easy. So if you have personal obligations beyond yourself, your risk tolerance may be lower than someone who has no other obligation than themselves. Your financial goals are another factor you want to consider when determining your risk tolerance. Is your financial goal to become a deca-millionaire one day? To rub shoulders with the rich and famous? If this is your desire, then you must get comfortable with the risk. All wealthy, and especially the ultra-wealthy, are masters of risk-taking. And because they took risks, they were handsomely rewarded. If your financial goal is to acquire a large fortune one day, holding 100% bonds will not get you there. It's like trying to drive cross-country with your parking brakes on the whole time. But let's say that your financial goals are more moderate. You're okay with acquiring some wealth, but just enough to be comfortable. And comfortable is a subjective description, so I'm talking about simple comfort. Roof over your head, ability to put food on the table, just simple things in life. In that case, you might be okay taking less risk, and your risk tolerance could be lower because your financial goals don't require you to take on big risks. The fifth factor to determining your risk tolerance may be the most important, and that is your personal tolerance to risk in general. In other aspects of your life, outside of money and investing, how do you approach risk? Are you the type that loves bungee jumping in the jungles of Brazil? Or do you never jaywalk, even in your own neighborhood where there are hardly any cars? And when it comes to investing, how would you feel if the market dropped by 30% tomorrow? Are you the type of person that can emotionally weather that kind of a dip? Or would you have a hard time sleeping? Take a look at the chart here I borrowed from Boglehead's Guide to Investing. This chart shows maximum annual loss and the average annual return an investor would have incurred during the period from 1926 to 2012 based on various stock to bond allocation. Now imagine you are 100% in stocks because you believe your heart is made of steel. At its worst year, you would have lost 43% of your portfolio. Are you okay with that? If not, what level of worst case scenario would you be okay with? Only you can answer that. And you need to look hard at yourself to determine the ability to tolerate risk based on all the factors that we've considered so far. Your income, time frame, obligation, and goals in combination with your personal risk level. Alright, now that you have a general idea of where you might stand with your risk tolerance, let's apply that towards building your ideal asset allocation. There's a wide range of risk tolerance and how it can translate to asset allocation, but for simplicity's sake, I'm going to use 3 levels. First level is conservative. If you're conservative with your risk tolerance, you don't like volatility, and you would never even think about bungee jumping in the jungles of Brazil. You hardly like crossing the street. Second level is moderate. If you're moderate with your risk tolerance, you're okay with some level of volatility, and you might go bungee jumping sometimes, but maybe ziplining is more your type of sport. The third level is aggressive. If you're aggressive with your risk tolerance, you love volatility, because that means more risk and more reward. And you would not only go bungee jumping in the jungles of Brazil, you want to go skydiving in New Zealand afterwards. Of course, I'm exaggerating here, but these 3 levels of risk tolerance are good reference points for our discussion. The probability is that your personal risk tolerance and asset allocation should fall somewhere in between. And when it comes to constructing your portfolio, I'm going to talk simply about the combination of stocks and bonds. A good analogy I like to use with stocks and bonds is that stocks function as your core wealth building engine. Without it, you aren't really going anywhere. And bonds are like your brakes. Without it, you could drive yourself off the road. When you have bonds in your portfolio, it helps to smooth out your investment ride because though they have lower returns, they have less volatility. Stocks, of course, should be made up of total market index funds like VTSAX, and bonds should be made up of total market bond funds like VBTLX. At times, we'll read or hear about investors claiming great returns from exotic sounding securities like gold, options, commodities, crypto, or NFTs. My advice is to forget about them, especially as your core portfolio holding. Most of these investments are highly complex and not for good reasons. And oftentimes, they're heavily sold to investors who have little understanding of the risk involved. A general rule of thumb I like to use is this: I don't buy anything I can't explain to my 12-year-old nephew. Alright, now what could a stock to bond asset allocation look like for each level of risk tolerance? If you're aggressive with your risk tolerance, meaning you actually embrace volatility and you have a long time horizon for your investment, a 9-to-10 stock to bond ratio might be okay for you. You might even be able to push it to 100% in stocks if you really want to be aggressive. And if you're in your 20s or even 30s, I would actually recommend this given you have time on your side. When you're young, risk is your friend. Don't shy away from it. Now, let's say that you're more moderate with your risk tolerance, meaning you're okay with volatility, but because you may have a large family or your income isn't as consistent, you don't want to be so risky. Here, a 80-to-20 or 70-to-30 stock to bond ratio might be the best. You have enough stocks to take advantage of the market, but also enough bonds to smooth out the ride. If you're in your 40s or 50s, you might be in this bucket. Alright, let's say that you're conservative with your risk tolerance. You're in the later stages of life, so retirement is right around the corner. And you don't need to become ultra rich in your lifetime. You have your lifestyle and you just need the ability to fund it. In this case, a 60-to-40 or even a 40-to-60 stock to bond ratio might be a good option. You can taper your bond up or down based on how conservative you are. Now, given what I just went over, I do want to say that you shouldn't get too fixated on the exact percentage. 10% more or less of an asset class shouldn't make a significant difference in your portfolio performance. Investing in asset allocation, despite what some may say, is actually soft science. Unlike a hard science experiment, past performance will not repeat itself exactly in the future when it comes to investing. So understand your risk tolerance and select an appropriate asset allocation. And know that you can always change it. And I like to believe that risk tolerance isn't fixed because it's like a muscle that you can develop. You might be more conservative now because your understanding of the market and your experience with it is limited. However, with time and experience, you might be more comfortable being moderate or even aggressive. Now, if all this risk tolerance and asset allocation talk gives you a headache and you want the simplest solution possible, I would actually recommend checking out what's called a target date fund, where all of this is done for you automatically based on your estimated retirement year. I have a whole video where I deep dive into it here, so check out to see if this is something that might be right for you. Thank you guys for watching, and until next time, all the best.